Let's just for folks who maybe haven't been as intimately, aware of how the model works. Let's just break it down. So take me into the boardroom, into the mindset of the private equity group when they identify an industry where they want to play. Let's say they're doing a roll up of HVAC companies, for example, or plumbing companies or veterinary clinics. What's the playbook?
So typical playbook is I want to identify and find what's called a platform investment or a platform company. So I've spent time researching an industry. It meets my criteria, which means it's highly fragmented. And why that is important is just simply because if there are 40,000 HVAC companies in the US or 50,000 veterinarians in the US, it's so fragmented that there's not enough buyers to buy all of these small companies, and the prices to be paid for the individual small businesses will be low. But so here's some quick statistics. In the United States, there are 33 million small companies just in this country. But globally, there's only 3,000 that have $1 billion in revenue, 2,000 of them public, 1,000 private, which means that as little companies get bigger, they become rare very quickly as you're climbing the pyramid. And so bigger companies are worth more than smaller companies. And so that's a basic tenet that the PE firm, is going to embrace. I'm going to start with a platform company. I'm going to find a good company, run by good people, because I don't want to buy a fixer-upper. Life's too short for that. Let's buy a good company, partner with a good entrepreneur, a good person, and I'm going to give them their liquidity event and then make them a rollover investor so that we're aligned. So when I exit, they're going to get a second bite of the apple. They're going to be happy, and I'm going to get them to work hard alongside me as a private equity firm. And now I'm going to become their partner, and I'm going to help them with growth strategy, and I'm going to help them solve for capital needs. And it's not just the bank, the checkbook that I bring to the table, but it's also the relationships with debt providers that I've got. And so we're going to work together over about a 5-year period, and we're going to work on growing organically. And so selling more stuff, and we're gonna focus on raising prices. So what's better than selling more stuff? It's selling more stuff at a higher price. And then we're gonna focus as we get bigger on margin improvement by creating operating leverage. We get bigger. Hey, if I'm that plumber you're talking about, and I've got 500 vehicles, I'm getting a better deal buying 500 vehicles than I am when I was buying 5 or 6. And so I'm creating operating leverage as I'm getting bigger. I'm collecting companies, I'm adding them. And then at some point, I'm going to have to exit as a PE firm. So let's just talk real quick about PE in general. So everyone knows what a mutual fund is. I can go on my E-Trade account, my Schwab account. I can buy a share in a mutual fund today. There's like Morningstar rating systems that tell me a good fund from a bad fund. And I have instant liquidity. It's a public stock. I can buy and sell it at will every day, any day, or I can hold it for 50 years. I have liquidity. So private equity is very much like a mutual fund, except for there is no liquidity. It's private. That's why it's called private equity. So minimum investment size about $5 million. So have to be an accredited investor. Majority of the money invested in private equity comes from university endowments and from public pension plans.
Adam, I just want to stop you for 1 second. You're referring to limited partners as opposed to general partners at private.
Correct. So the PE firm, the typical PE firm, does not have capital. They have management of capital, and so they have to raise capital. So they're raising capital in $5 million minimum size chunks from pension funds and from college and university endowments. People who've got money in longer term investment horizons. I take all that money. I have 10 years to invest it. And so generally, I call it the tide flowing out and the tide coming back. It takes 10 years. During the first 4 or 5 years of the fund's life, I'm buying companies. In the middle years of the fund, we're buying other small companies, doing add-on investments. We're growing them. We're improving operations, working with our partners, our former owners, who used to be independent. We're building a bigger company. And then towards the tail end of that fund's life, we're selling these companies because we have to return the liquidity or the money back to our limited partners. They haven't seen it for 10 years. They invested with us because we doubled the S&P 500 on average as a PE firm. We're giving great returns. And so we got to return all this capital. So it's about a 10-year lifespan for a PE fund and a company. When the phone rings and they're looking to buy us, it's either to make us a platform investment, of a fund, or to be an add-on investment to another company that's bigger that we already own that is our platform investment, and we're doing add-on acquisitions to get bigger. And so it's essentially private equity is a large pool of institutional capital that's raised from limited partners. As the PE firm, I'm the general partner, and I'm making all the investment decisions. I've got 10 years to put the money to work, to build the companies, and then return the capital to my limited partners. And so that's kind of what it is, what it's doing, how it works. And, when it works well, it's a big industry now. When I first started as a CEO, there were about 1,400 PE firms in existence. There was about 800 billion in assets under management. Today, you're over 6 trillion in assets under management, wow. 8,000 firms or more. And so the asset class has just gotten huge. Today, they buy and sell, over 50% of all companies bought and sold on the planet.
Wow. So if I'm an endowment for a university and I say, okay, I'm going to go give $10 million to this private equity group over here. I'm going to give it to them for 10 years to what am I hoping? What's a successful amount of money that I get back if I give them 10 million? What would be like they expecting after 10 years?
So if I were to take that 10 million and put it in the stock market over a 30-year period, I would average somewhere around 7 to 8% return per year. In the world of private equity, I'm looking for double that. I'm looking for about 16 to 20%. And of course, I don't always get those type of returns. Sometimes it's less, sometimes it's more. But a top quartile or the top 25% of PE firms out there, funds are rated just like mutual funds are rated by Morningstar. There's other services that rate PE funds. And so, a top quartile or the top 25% of PE firms and funds out there are probably returning somewhere between 16 and 25%, depending on where they fall in that framework. And so I'm getting better than an S&P 500 style return. I'm giving up liquidity. So I tie up that money. I'm not going to see it for up to 10 years, but I'm getting a double market return. So if I'm like a public pension fund, I have short-term obligations, pensioners I have to pay who are already retired. So I have to keep liquid assets out. But I've got younger future retirees that I'm going to have to pay for, down the road. And I have a longer horizon to invest. And I need higher returns in order to meet all my obligations. So I'm seeking alpha. I'm looking for higher returns than I can get in the stock market. And private equity as an asset class has become one of those places where I can invest my capital.
Okay. I want my listeners to hear this because when you get approached by a private equity group, know that they're trying to grow the value of your business by combining with others, improving margins and so forth, 20% a year. Or 16 to 20, 25. Like that's what they're trying to do because they could give the money to the stock market and get 7 or 8 points a year over a 30-year horizon, or they could give it to a private equity manager who's going to try to grow it. So that's, I think, one thing that they need to understand is that for this all to work, the private equity company needs to grow value, call it 16 to 25% or whatever, roughly that space, much more than a publicly traded stock would do that. So Adam, how do they do that? Like, what's the playbook for improving the value of the businesses that they acquire?
So my playbook really been the same my entire career. And it has those 3 elements I already touched on. So I'm seeking to grow the business at a faster pace organically than it had been historically growing at. And I call it price volume pivot. So I want to, most companies that I get into have a ton of room to further optimize price. And so, if I walk into a contractor's business and I say, look, if I raised every bid you put out last year by $1, do you think you would have lost any bids? And the answer is no. And of course, I'm doing $10,000 jobs, $50,000 jobs. Yes, I could have raised my prices $1 and I wouldn't have lost a single bid. Great. Let's find that place where if I do add one more dollar, I do get no as the answer. And let's get right to that breaking point, and so we have to learn how to optimize price. And then, a volume. It's like, what does our sales effort look like? What is the potential to become more aggressive from a sales perspective? Can we add more volume, and on top of that, add price? And then I have this thing I call pivot. What's pivot? Well, the hardest thing for customers to do, or for a company to do, is to find a customer. Well, once I find a customer, can I sell them something else? And can I create a suite of products and services or recurring needs that I can fulfill? And then, so like, let me give you a great example. Let's use pest control. So I'm here in Texas. I got giant bugs that you could put a saddle on in the summertime. It's like, oh my God, it's like they'll scare you, half to death. But, I have this pest control company, not one, because I don't like bugs. I've got two pest control companies, and I sign a contract. That contract never expires. It's recurrent revenue. It's month to month. It just goes on forever. They've got my credit card. And so, they charge me every month, which keeps the price low, but they only come out once a quarter. And they come out once a quarter and they spray around my house. And then they tell me, hey, Adam, you know what? We got giant mosquitoes here in Texas too. So I can add a different service. And now I can charge you a second fee. And I'm going to come out with a different truck, different dude, and I'm going to start spraying for mosquitoes. And, oh, hey, Adam, there's also termites here. And so that's not really covered by perimeter stuff. So that's a third contract. And, hey, you know what? Your lawn looks a little green over there, but it's a little yellow over there. And I peeled back your side. There's army worms over there. It's like, I got to spray your grass. That's another contract. That's another fee. And so it goes on like that. Or I'm a landscape maintenance company. It's like, okay, so I'm mowing your grass. But you know what? I can also remulch your beds, and I can do your sprinkler repairs, and I can do your holiday lights. And it's like all these different things that I can sell that central customer. And if I can do it with a recurrent revenue contract, then my revenue streams are secure. And instead of looking for a new client, to replace an old stream, a new client becomes additive because the old client hasn't left. I've got a contract and they just keep on needing my bug spray, or my landscape maintenance. And so I find all these ways to grow organically. Maybe I do something the entrepreneur wasn't doing. Hey, you know what? You're looking pretty good here in Dallas, but let's open up in San Antonio. Let's open up in Houston. Let's go to Oklahoma City. Let's go to San Antonio. Let's open 5 more branch offices, something you might not have thought of doing. You were content with the growth rate of your business, but now you got my checkbook. Let's start expanding faster. So the point I wanted to make here was that it's not just inorganic. It's not just buy a bunch of companies and put them together, although I'd say that that's probably the biggest value creation lever there is because it's really efficient. If you take the last company that I built, I bought 23 companies and put them together and stuck them on top of my platform or the company I started with, which was a little bigger. And I buy 23 small companies, and on average, I paid 5 times earnings for each one of these small companies. But when I put them all together, combined them, I created operating leverage. I was growing organically. We made our strategic pivots, price, volume. We had worked to improve our margins. And then I sold it for 14 times. And so for every dollar of revenue or earnings that I bought and paid $5 for, I now sold it for $14. I borrowed 100% of the money to buy these 23 companies from banks. The cash flow of the businesses I bought serviced the debt that I was required to use to pay. I got $9 of profit on every dollar of earnings that I bought. And so I'm making hundreds of millions of dollars in profit because I have a big checkbook or I've got debt relationships with banks who will give me a disproportionate amount of capital for the size company that I am. And it's like, this is the playbook. This is the script. And this is the script that is being played over and over and over again, every day in a bunch of different industries, all around the globe. And it works. And so what we get as entrepreneurs, we get to ride the coattails of what is probably the world's most sophisticated asset class, who's been more than doubling the S&P 500. And I can sell my business, be a rollover investor, get diversification, ride their coattails, and get second paydays or third paydays. And the combination of all of those paydays creates what I like to call generational wealth. And so instead of one stop, one and done sale of company, two or three, wealth creation rest stops later, it's like, boy, this money's piling up, and it's like life is good.